What is good, YouTube? It's your boy Teflon Don coming back with another video. Only Traders Gang, and we only trade every single day. And today we're going to continue with the Candlestick Trading Bible. And as you can see, we've got time frames and top-down analysis. So let's get straight into it. As a price action trader, your primary time frame is the 1 hour, the 4 hour, and the daily. At the same time, the 30-minute and the 15-minute very key. And price action works on bigger time frames. If you trade pin bars or engulfing bars on the 5-minute time frame, you will lose your money because there's a lot of noise on smaller time frames, and the market will generate a lot of false signals because of the hard battle between the bears and the bulls. Besides, there is no successful price action trader who focuses on one time frame to analyze his charts. Maybe you've heard of the term top and down analysis, which means to begin with bigger time frames to get the bigger picture, and then you switch to the smaller one to decide whether to buy or sell the market. Let's say you want to trade the 4-hour chart. You have to look at the weekly chart first, and then the daily chart. If the weekly and the daily chart analysis align with the 4-hour chart, you can take your trading decision. In layman's terms, if you see that the weekly and the daily chart are bullish, then most likely you're going to find buying opportunities on the 4-hour chart. And if you take a sell, you're basically kind of trading against the trend, because as you can see from the bigger time frames, the trend is bullish. So that's going to affect the smaller time frames as they're going to eventually become bullish. And if you want to trade the 1-hour chart, you have to look at the daily chart first. This is a critical step to do as a price action trader because this will help you avoid low probability trading setups and will allow you to stay focused on high probability price action signals. Through our top-down analysis, we always start with the bigger time frame, and we look for together the following information. So the most important support and resistance levels, these are areas representing turning points in the market. If you can identify them on the weekly chart, you will know what is going to happen when the price approaches these levels on the 4-hour chart. So you'll decide to either buy, sell, or to ignore the signals you get from the market. The market structure. The weekly analysis will help you identify if the market is trending up or down, or it is ranging or choppy. In general, you'll know what big investors are doing, and you'll try to find a way to follow them on the smaller time frames using price action strategies. The last candle on the weekly chart is important because it tells us what happens during a week, and it provides us with valuable information about the future market move. When you identify these points using the weekly chart, you can now move to the daily chart or the 4-hour chart and try to gather information such as 1. The market condition, what the market is doing on the 4-hour time frame. Is it trending up or down? Is it ranging or is it choppy? 2. What are the most important key levels on the 4-hour or daily time frame? This could be support and resistance, supply and demand areas, trend lines. 4. Price action signal, a candlestick pattern that will provide you with a signal to buy or short the market. This could be a pin bar, an engulfing bar, inside bar, etc., etc. Many different candlestick patterns. So let me give you an example of how to understand why it is important to adopt the top-down analysis concept in your trading method, and what is going to happen if you don't look at the bigger time frame before switching to your primary chart. Look at the illustration below. And just to add on that, I would suggest you always have a time frame where you identify market structure, typically 4-hour going up. Then you'll have a time frame where you're going to identify your pattern, and typically that will be the 1-hour and the 30-minute chart. And then you'll look at the lower time frames to find an entry and confirmations for your entry, and that is typically done on the 30-minute, 15-minute, and at times the 5-minute time frame. But the 15-minute is probably the best time frame that you're going to get to identify entry, due to the fact that it doesn't move too fast and it doesn't move too slow, as opposed to the 5 minute where it moves really fast, so there'll be a lot of noise, and the 1 hour chart where it moves slow, so a move might start and you might miss out on it because you're only looking at the 1 hour chart. Let's continue. As you can see in this weekly chart above, we have gathered 2 important points that will help us decide what to do on the daily time frame. The first point is the market approaches to an important weekly resistance level that will represent a hard point in the market. The second information is the rejection from this key resistance level. As you can see, the price was rejected immediately when it approaches the level. This indicates that there are sellers there and they are willing to short the market. What confirms our analysis is the information of the inside bar false breakout patterns that indicate a reversal. Now let's switch to a daily time frame to see what is going on in the market. So on the daily time frame, we have a clear pin bar candlestick pattern that indicates a bullish signal. If you focus just on one time frame to make your trading decision, you'll buy the market because there is a clear pin bar signal. But if you analyze the weekly chart, you would know that there is a very powerful key level that will stop the market from going up. So it's better to think of selling the market if there's a clear signal rather than to buy it. Look at what happened next. As you can see, the top-down analysis works. The pin bar candlestick signal didn't work because the weekly resistance level was a powerful turning point that reversed the market direction. If you want to trade price action based on one time frame, I highly recommend you to stop trading because you're going to blow your account and you'll never be a successful trader. Trading counter trends is very profitable as well, but without the top-down analysis, you'll put yourself in trouble. And trading counter trends is very risky because you're basically going against the market structure. So let me give you another example to show you how you can trade counter trends using your price action trading setups in combination with the top-down analysis concept. As you can see in the chart above, price at a weekly resistance level. Buyers were rejected twice from this level, which indicates that it's a hard point and it's likely to reverse. What you can do as a price action trader is to switch to the daily time frame to look for a selling opportunity. If you can find a price action setup near the weekly resistance level on the daily time frame, this is going to be a high probability setup to take into consideration. Look at the examples below, and they show that the daily chart above confirms our weekly analysis. As you can see, there is a clear bearish signal near the weekly resistance level. The pin bar is rejected from that level, and there is also formation of an inside bar false breakout. This is a clear indication of a trend change. And let's see what happens next. So the example above shows that the counter trend works if it is well mastered, well timed, and if you have experience. It is a contrarian approach that requires experience. So if you are a beginner, I highly recommend you stick with the trend. Try to practice as much as you can the top-down analysis concept with the trend, and when you master trading with the trend, you can then move to trade high probability counter trend setups on your demo account. Not on your live account, on your demo account. You go and you practice on your demo account, or you backtest that shit. There are many approaches used to time the market turns and plan trades. The most of these approaches lead to greater confusion and lack of confidence in the results. Keeping the analysis simple is most often the best way to go, and top-down analysis is one of the easiest approaches that I recommend to master if you want to trade the right way. What you have to do right now is to open your charts and try to practice what you learn in this chapter. So I would suggest that all of you go on to TradingView, beautiful platform. I ain't an advocate for TradingView, but I personally know that if you are a trader, you're using TradingView. If you're just lying to us, you're going to use another charting platform. And yeah, just go onto your TradingView, try to install these concepts onto the charts. Try to go like step by step from the beginning of this video and slowly build up to a point where you've completed the chapter and you've been able to do all of the things that are required for the top-down analysis to work. Because without top-down analysis, you're not going to be a successful trader. That is a guarantee. Oh, my mama. So try to identify the market trend using these techniques. It'll be a little confusing at the beginning, but with screen time and practice, you'll find it easy to identify market direction. And that's true, man. I would suggest even if you don't know what you're doing, just do it still. At some point, you're going to figure it out. The more time you spend on the charts, the more questions you're going to ask and the more problems you're going to solve for yourself. So that when you do begin live trading, you're in the best position to protect your capital. Not to make money, to protect your capital. That's the first thing you should always be aware of when you go onto the chart is, I'm going to protect my capital. Once I've protected my capital, any gains that I make, I'm going to capitalize the fuck out of them to the max. So that's how you're going to make your money. You protect your capital. And when you get that set up, when you get that perfect entry, capitalize on that motherfucker. Make sure you take all the pips that you can in conjunction with your analysis and your discretion and your level of ability to take risk and what you can manage. Because, man, you're going to see that motherfucker go up and down, green, red, green. And you're going to be tempted to, take small profits. But in the long term, man, it's a long-term game. In the long term, that's going to kill you because your losses are going to start to outweigh your wins. So make sure you capitalize on your wins. Make sure when you set your take profit, stick to it because you know your trading plan. And you know that if you take profit this amount of times with this amount of pips, you're going to make this amount of money. And you know that if you get stopped out this amount of times you know that at the end of the day, your wins are still going to outweigh your losses because you're going to lose. That's a guarantee. Guaranteed fact, man. So every day we're just trying to protect our capital, and we're just trying to stay in the game, man. So that's the key, man. Just stay in the game up until you can stop playing the game. Because some people, they come into the game, they're taken out on their first day, on their first week, never to return again. But we always come back, and we come back better, baby. Because there's money, man. There's money being made. So you might as well just, hang in there. Try to figure it out. I promise you, even if you don't know what you're doing, my G, keep doing it. You will figure it out at some point. With that being said, Only Traders Gang, merch coming soon. Deuces, baby.